Okay, let me now welcome on board Krishna Memani, CIO at Lafayette College, to try and understand what his thoughts are as we approach the tariff night. Mr. Memani, great to have you today on ET Now. Trump's reciprocal tariffs, which are set to begin with immediate effect come tomorrow. How is it that you expect this to alter the risk-reward calculus for US equities, particularly in sectors like technology, industrials, with high foreign revenue exposure?
Well, so the uncertainty with respect to the tariff situation has been with us for quite some time, and it's probably going to be with us for an extended period of time. I don't think on April 2nd, all of a sudden we'll learn something that'll change the dynamics in a meaningful way. Having said that, I think there are two aspects to tariffs. One is the uncertainty that it creates in the US economy, and if you look at any of the survey data, it clearly tells you that the level of uncertainty is probably the highest that it has been in almost 10, 15 years, with the exception of the COVID episode. And the other interesting thing is, to some extent, it is self-inflicted. That is, it is because of the policy choices that the administration is delivering on. So the uncertainty is real. Uncertainty will have an impact on US growth prospects, and therefore it'll have an impact on US profitability and US equities in a meaningful way.
Right. Krishna, you've described the current market as a T-bill and chill environment. What specific signals are you seeing that suggest limited upside for stocks in the near term in this very elongated, uncertain environment?
So there are two aspects to that. One, in this sort of an environment where uncertainty persists, the likelihood that labor market strengthens, or for that matter, investments get going, is pretty low. This is an environment where the best case you can hope for is the labor market doesn't crack, and whatever investment plans people had ahead of the uncertainty manifesting itself, they continue with it. So in that context, that puts a meaningful pressure on outlook for growth and profitability growth in particular. So that I think at the end of the day, it's really that matters more for U.S. equity markets, given that the valuations are were pretty stretched when we came into the year and rallied all the way up to 61, 6,200 level for the S&P.
Right. So with potential retaliatory tariffs from trading partners like Canada and Mexico also looming, how might this affect investor confidence in U.S. large cap stocks? And, the tech names, for instance, would you recommend shifting towards more defensive sectors like utilities or healthcare?
The issue with the US large caps is their valuations were pretty high to begin with. So in that environment, any bit of uncertainty really puts a damper on things. That is, they weren't cheap. If they were cheap, one could make a case that, well, the bottom is near. We certainly cannot say that with a great deal of confidence. That said, I think the issue with large caps isn't profitability just yet. Issue with large caps is valuations and uncertainty rather than profitability. There will be an issue with profitability, but that probably doesn't come about till the second half of the year at its earliest. So the trick with large caps is, if you're going to buy the dip, if that's what you are inclined to, just remember two things. One, they aren't very cheap to begin with, and two, if the market rallies back, the likelihood of policy innovation or policy experimentation actually goes up. So that increases your uncertainty more rather than reducing your uncertainty. What we need is uncertainty to go down, and that's probably not happening anytime soon. There will be a time to buy this market because US profitability is still pretty good, but it's not at 5,600 in my judgment.
And this stretch on valuations, you think, is more for the tech names? I mean, Tesla, of course, has already given up a whole lot from its 52-week tops. Or would you say that that's the case build up for even the S&P 500 cohort?
So I think valuations were the highest in the tech sector. But, they had a very robust run over the last 2 years, and the valuations were stretched. And I think the AI thing got it going even more. And on that front, you really have after DeepSeek, you basically have a broken narrative in the market. So the valuation picture or continued expansion of valuations for tech names was suspect even before tariffs came into the picture.
Mr. Memani, the uncertainty surrounding the scope and duration of Trump's tariffs could spike market volatility, right? What strategies would you suggest investors to hedge against this uncertainty in the weeks following today?
Well, so kind of trying to hedge uncertainty in the capital markets by transitioning from one sector to the other, it really hasn't worked out. If you adjust for the beta of a particular sector, if the markets are going to have a substantial correction, I think you are going to have that substantial correction basically across the board on a beta adjusted basis. So if you are looking to hedge your bets, the only place where you can hedge your bet is but two ways. One, cut your exposure, and that's always a solution. Second one is if you have $2 to invest, you're probably better off investing in the bond market than you are in the equity market. The challenge with equity market is not that the overall U.S. economy and profitability picture is bad. It's just that valuations are high and uncertainty is going higher. That doesn't bode well for valuation expansion, and as long as that is the case, it's not going to work. On the other hand, if we do have a recession, despite the concern about inflation and things like that, I think any developed market bonds like U.S. with a 4 handle, I think is a reasonably good buy.
Right. So there's going to be tariffs on auto, steel, aluminum among those proposed, right? How do you see these sector-specific measures impacting the relative attractiveness of domestic versus international equity investments for US-based portfolios?
Well, so the attraction of international for a U.S. investor, and we happen to invest on a global basis, is the fact that valuations are much better, and the fact that the dollar may be depreciating in that context. I think that is a debatable point. If the dollar doesn't depreciate, then the attractiveness of overseas markets, I think one can question that particular judgment. So I think overseas markets are interesting because on 2 fronts. One, their valuations are much better than the U.S. markets, and 2, from a policy standpoint, at least from a fiscal policy standpoint, the risk we have is the U.S. gets into a contraction while the fiscal policy moves overseas get expansionary. That is, whatever your view is, whether that is right or not, that ends up being really supportive of international markets when you have that dichotomy.
Right. So, Mr. Memani, 2 scenarios. If Trump's tariffs lead to a stronger US dollar, as some do predict, or scenario 2, a weaker dollar, as also some predict, how do you think these 2 are going to influence your allocation decisions between US fixed income, equities, and of course, emerging market assets in the short term?
Yeah, so that's an interesting question. I think we are long-term investors, so we have a strategic asset allocation. We stay close to it. So the first thing I would say is that in this sort of an environment, the best thing you do is remain as close to your long-term allocation rather than make a tactical allocation into any one particular sector. Second, I think the outlook for stocks globally, set aside international, domestic, I think outlook for stocks globally, this is not the sort of environment where things do well. I mean, things may hold water and things may tread water, but the likelihood that you have a substantial rally, which is really what you are trying to play for, I think this is not the environment where that happens. It can happen, but for that, the levels in the markets have to be meaningfully lower and people have to capitulate, and they certainly haven't done that. So I would say the second point I would make is bonds are better value than stocks, for the simple reason that even if you have inflationary concerns, those may end up being somewhat transitory. I know that's a bad word, but I think tariff-related inflationary pressures would probably peter out after a while. And even in that environment, if you have a significant slowdown in the U.S. economy as a result of these tariffs, the U.S. bond market is actually going to rally. So the point I would make is this is not an environment for equities. This is, if you have any money to invest, bonds are probably a better purchase. As far as the dollar is concerned, I think that is one of the things that I'm struggling with a great deal. That is, I can make a case both ways. I think, given the level of uncertainty that we have and the potential for mishap in the global context, I think maybe being short the dollar makes a little bit of sense in the short term, but being short the dollar in a meaningful way in case things go south substantially, I think that's not what you want to do, because that can turn around very, very quickly, much quicker than either the bond market or the equity market.
Right, Mr. Memani, so with Trump potentially reintroducing aggressive tariffs in 2025, how is it that you see this impacting U.S. inflation and the Fed's ability to manage monetary policy?
That's, again, an interesting question. I think I can say one thing for certain. The Fed, on its own, using its typical monetary policy toolkit, is basically out of the picture. That is, the growth is not large enough for them to be raising rates, and I don't think for tariff-related pickup in inflation, they are going to be raising rates. On the other hand, inflation north of, let's say, 3%, 3 and change, if everything gets implemented, in that environment, they can't cut rates. So on a typical monetary policy framework, there is nothing coming out from the Fed. On the other hand, if the U.S. economy slows down and we have whiffs of a recession, I think the Fed has the room to cut, and I think they will cut despite inflationary pressures. And they will justify it, basically saying that on a forward-looking basis, the weakness is the mix of things is more towards weakness rather than strength, and especially in the labor market, and they will fall back on their dual mandate.
Right. So, Mr. Memani, Trump's tariff policies obviously, previously strained trade relations with China. If these measures return, how might this affect China's economic growth and its role in global supply chains, and, of course, impact their equity markets as well?
Well, so if you look at Chinese surplus, this is probably the highest level of surplus in nominal terms that they have had in the history of the country. So I think if tariffs are substantial and that leads to reduction in exports, that will have substantial impact on the industrial economy in China. Having said that, I think they have the policy room, they have the ability to do things on the domestic side, and they will probably do that. So, and given their political structure, expecting them to kind of basically wait for things to normalize and not do anything while the economy is slowing down substantially, I don't think this is a realistic expectation. So I think from a growth perspective, China's economy probably will be helped by a stimulus that comes on the back of the impact of tariffs and slowing export. Having said that, I don't think that will lead to a really good outcome for the Chinese stock markets, despite the flatlining of the economy at, let's say, 5-6% type level, which is where probably it ends up. If you look at the reaction in the Chinese market, it really has been primarily in the large cap sector, and if you look at it's been primarily in ADRs and net share H shares rather than A shares. So that sort of tells you what the driver is. The driver is foreign flows rather than the domestic flows out of confidence being lifted in Chinese economy by Chinese investors.
So you're saying that tariffs do pose a risk to foreign inflows into China?
Oh, absolutely. I think if the tariffs are there, they persist, I think the likelihood of the flows continuing into foreign equities out of the institutional investors' U.S. allocation, I think is pretty small. I think what is more likely to happen is basically equity exposures on a global basis will start coming down, and people would be starting to allocate into bonds as a safety play, even if inflation persists.
Mr. Memani, have to talk about India because that's been positioning itself as an alternative to China for manufacturing and investment. Do you think Trump's tariffs could accelerate this shift? And how would you say that would influence investment into Indian equity market portfolios? Because we've already seen that crack from the 52-week peaks, and we're on our way to a meaningful rebound as well.
The focus on manufacturing in India is from a domestic policy standpoint, creating jobs has to be the number one political and economic objective in India, and anything that you can do to help that would certainly be a good policy outcome. Having said that, I think India in all of this is probably not out of the woods as well from a tariff standpoint. So we just have to wait and see as to what magic Mr. Modi can create with his relationship with Trump to see on a reciprocal basis what kind of dispensation that he can get. And I think a lot of those flows are probably going to depend on that outcome. Again, I think the net outcome for tariffs on a global basis is really reduction in U.S. growth, and therefore reduction in U.S. Imports because of slower growth and higher tariffs. And that doesn't bode well for a substantial increase in foreign investment. Not in this environment anyway.
Sure. So between India and China, which emerging market do you see as better equipped to weather the storm of a renewed US tariff regime, and why? Because for many investors, it's still a very India versus China play.
The Indian economy is a domestic economy for all practical purposes. So I think the kind of stability of the rupee is important, and that we kind of have to keep that in the context, because otherwise things get, from a budgetary standpoint, things get out of whack very quickly. But it is a domestic economy. So I think India has a lot more levers to push to kind of change the dynamics and continue down its growth path than perhaps China has in the current situation. And I think the policymakers have kind of indicated their willingness to do that far more emphatically in India than they have done in China. So I think tariffs are bad globally. Tariffs are bad for exports. Tariffs are bad for economic growth. But I think India has the tools, and the structure of its economy is helpful in the context of continuing to implement good policies, even if things slow down from an exports perspective.
Right. Mr. Memani, you've mentioned the possibility of a recession if Fed policy becomes overly restrictive. Tell me, what's the current probability estimate of a recession in the US in the next 12 to 18 months?
Well, I'm an investor, so I'm not in the business of forecasting probabilities. But I would say that the U.S., because of fiscal spending that has been in the pipeline and the trend in fiscal spending, I think the likelihood of a recession is pretty small still. And the more likely scenario is that we get to sub 1% type growth, and it wouldn't be a recession. But from an equity market standpoint and from a real economy standpoint, it'll certainly feel like a recession, even if we can claim that, well, we never had the 2 quarters of negative growth that we needed for it to be a recession. The other point I would make is the monetary policy is not overly tight at the moment. I think monetary policy would become tight if growth slows down substantially. Then they will have to do things even if the inflationary picture doesn't improve meaningfully.
Right. So, Mr. Memani, how is it that you're positioning Lafayette College's portfolio in response to Fed's current stance, more towards fixed income, equities, or alternative assets?
No, again, as I said before, we have a strategic asset allocation, which is equity focused, because our investment horizon is 10, 20, 30 years. And in that context, kind of underweighting equities in a meaningful way doesn't make much sense. So whenever we have free cash flow available, we try to deploy it in sectors other than equities, and including away from things like private equities, which we traditionally have invested substantial amount in, because this is not the environment where any of those sectors are going to do well. But having said that, we have to set up a portfolio for 10 years rather than what is going to happen tactically in 2025.
Right. So lastly, Mr. Memani, looking beyond Fed policy and the global factors like geopolitical tension, supply chain dynamics, what do you think is going to really dictate the markets in 2025? Or is it always going to be valuations and earnings growth that will be the key?
I think if you had asked me this question in 2024, I would have said that the global environment for the next couple of years will probably be driven by growth outlook, AI, and what happens from an industrial policy standpoint in the U.S., where we are trying to revive certain sectors in the market, and what the implications of all of that is going to be from a long-term productivity and growth perspective. But I think all of that has gone out the window. Right now, the effort is to make sure that we don't get into a terrible situation from what would have been otherwise a decent situation because of tariffs. And again, full disclosure, it's very open-ended still. He may announce a particular set of policies in a few days, but at the same time, he's been known to change his mind quite quickly as well. So it's not all lost, but if this trend persists, I don't think the outlook is going to be dominated by anything other than tariffs and tariffs' impact on global relations and tariffs' impact on U.S. growth.
Right. Mr. Memani, thanks so much for your time today. Good speaking with you and a lot of food for thought. Thank you for your time.
If you like this video, then like, share and subscribe to ET Now.